Welcome to Southern Soul Chats, where real conversations meet faith-filled truth. This season, we're stepping into a special series called Faithfully Funded, where we talk about money through the lens of faith, trust, and relational equity. Because every dollar carries a story, and how we handle money shapes not only our finances, but our relationships and our walk with God. I'm Dr. Miranda Ferguson, and this season I'm joined by Matt Miller, author of Two Sides of Every Dollar. Together, we'll explore money not just as something to manage, but as a mirror, revealing what we value, who we trust, and how we love. So wherever you're listening from, lean in as we learn to live and give faithfully funded, one step at a time. Hey guys, welcome to Southern Soul Chats. We are so glad that you have decided to join us in another episode of Faithfully Funded, which is what we're talking about this season. It is relational equity. We have an amazing co-host, Matt Miller. Matt, why don't you say hello?
Hello.
And today we're going to have a little more fun. I think that our topics haven't so much been heavy, but they've been really important and have a lot of significant value for many different reasons. But today we decided to do like some hot topics. Yeah, okay. Some hot topics in the world of money. So we have a few that we like just kind of picked and talked with Matt that we said, these are what we hear a lot of chatter about. And that we thought you guys would enjoy a conversation on. So we're just going to jump right into it.
It's funny when you say hot topics, you know what comes to mind for me?
What?
I can't help but think of Hot Pockets.
Okay, no Hot Pockets today, just Hot Topics, okay?
And we're going to miss Hot Pockets.
Oh, no, you don't, because they've changed. My kids, because they're kids, they like to eat them. They taste different. They're not as good.
Do you remember the little, there were like little pizzas. Not the little pizzas, but there was like, oh my goodness, it's going to come to me at some point.
Wait, like where did you have these? Now I need to know. I'm invested in the conversation.
They were little, like the little square shaped. It had the dough, and then it had maybe a piece of pepperoni in it. And then after school, I would eat 40 of them. It felt like
that sounds like a pizza roll.
That's what it was.
Okay, do you know that pizza rolls are very, very popular still in teenage households?
They were popular in my household.
Listen, there's 100 count in my freezer right now, and they will be gone very quickly.
And Steakums, that's what I also had too.
Yeah, so I grew up with a single mom. She was poor. I didn't get any of that stuff. I didn't get it until I was old enough to buy my own groceries. And so, yeah.
Gee,
womp, womp. It's okay.
Raised by a single mom too.
Hey, I'm just saying, everybody's food preferences were different. My grandmother made homemade biscuits and like gravy and deer meat.
I would have much rather had that.
That's absolutely. After school, I remember getting buttered toast because one of my cousins loved buttered toast. So she'd run in the kitchen and make butter toast.
With sugar on top? Cinnamon?
That's cinnamon toast, homemade. And yes, we still make that in the Ferguson household as well. Now I'm hungry. Thank you.
We probably ought to get back to what we were doing.
Instead of hot topics, we're going to talk about hot restaurants.
I'm sorry. I'm sorry.
Okay,
that's how my mind works sometimes.
Just to recap, yes, Hot Pockets are still out there. They don't taste as good. You can call me Hot Pockets. We can chat about it. And pizza rolls, still a very good pepperoni and combination. Oh, my.
Okay.
I'm going home to eat
Steakums?
I have no clue what that is. Clearly, I never saw a Steakum.
All right, well.
But maybe I should invest in Steakum. Okay, well, I'll give you one. I'll give you one that's off, and you may not have had this. Okay, stop sign pizza in the cafeteria.
Oh, I ate everything the cafeteria offered.
You were brave. I only the stop sign pizza. It was like a Mexican pizza. It had this real yellowy cheese on top and a lot of sauce. If you know where those are, please email me.
We used to run to the cafeteria on chicken fried steak day.
We never ran to our cafeteria.
Oh, man.
I remember hitting high school and thinking I'd arrived because they had potato wedges and cheese sauce. So if you didn't want what that mystery meat was, you could go over there. But man, pizza day, it was on. And the line was long.
Yep.
It was long. Okay, well, that was fun. Hot topics and food. Now we're going to do hot topics.
I deterred us. I apologize.
It's all good. Told you today's a little more fun, a little more relaxed. Woohoo. Okay, so we're going to just jump right off the cliff, pull the parachute, and we're going to talk about investing.
Okay.
I don't
Coming out
know.
of the gate strong.
I am not investing. I don't know a lot about it. It's not my area of expertise. The most I know about investing is probably what God talks about in the Bible when he talks about, investing the things and the tools and all that he gives back. So this is really going to be your train. Go.
Okay. Just like that? Okay.
Yeah, just like that.
All right, here we go. So much like I strive to do with other topics, I like to relate it to something.
Yep.
Okay. So when we're investing in our children, and I'm not referring to a monetary aspect,
Right.
I'm referring to investing in our children. What's the hope that you're striving for?
I hope to invest in them good morals, good values, strong foundation in Christ. I invest so they grow up to be young men who give back to the community, who strive for excellence, who love people, and who will grow up to be godly men.
Okay. So thank you for that. What else?
Was that the wrong answer?
No, absolutely not. You actually said the things that I wanted to use to help. What you spoke of is specific things that you want to instill for a future date.
Yes. Right.
Investing.
Yes.
That's the parallel. When we're talking about investing, we're talking about investing in something now such that later, at some point down the road, we're going to talk about college, I think, today too.
Yep, we are.
And inflation, I believe, and insurance. Stick around.
Yeah.
I'm sorry if I don't.
Right there,
don't
everybody
tune
just
out.
went
I'm
click.
sorry. That's why you didn't say it earlier. I apologize. I messed up.
No, but if anybody's been watching so far, they see that like what is on the surface is not what's deep down inside.
Hopefully, and hopefully that's good. So if you said what you said, you and Jeremy want to instill these things for a future date so that there's some type of return.
Yes.
Okay.
Yes.
That in theory is what investing is about. Okay. And the two of you will do that differently than your neighbors.
Yes.
And they will do it differently than them. And you may do it different than you were raised.
Yes.
Okay. Which is also something important to note, because risk tolerance, which, by the way, I think we said this in previous episodes, but my industry loves to use phrases or terminology that nobody else uses. Okay. And
or understands maybe.
I've been in conversations of which I totally know when I'm using our dialect rather than just
general
having a conversation.
knowledge.
Yeah, because they'll look at me like I have two heads, and I'm like, there it was. I did it. I did what I don't want to do. So you're going to do things differently than you were raised and than your neighbors do, and that's something that's different too. Investing is going to be different by person.
Right.
Okay, risk tolerance, one's ability to take on risk or to not take on risk. That's something that's important.
My husband says I'm risk adverse.
Okay. Okay. Does he specify why?
He said, well, okay, so again, you're talking about people are different, right? So I tend to be a more safe tracking, planning. Like I like to do things. My husband's a little more spontaneous with things. He gets interested by opportunities and that could require risk. Again, we have 5 kids. We have a mortgage. I'm more like, why don't we stick with what we know? And so I'll usually get like, you are so risk adverse. Like, just live a little. And I'm like, can't do it.
And I think that's good for you to both know.
Yeah.
Right? And we'll talk a little bit more about that. But
I take safe risks.
well, it's important to know in my world that there are all types of risks,
right?
All types of risks. So inflation risks, geopolitical risks, market risks, interest rate risks, all type of risks related to investing.
Right.
There is life.
I was about to say, it's also very risky in life to invest.
Everything comes at a cost, right? Yeah. We've talked about that multiple times. But in investing, there's various types of investments. We'll unpack that a little bit. I'm going to keep this very bland, simply because it's
not an investing class.
Yeah, and I'm not talking to you specifically.
Right.
Okay. So, but yeah, they're all different types of investments. They're all different types of risks associated with investments. Another aspect that's important is when's the money going to be needed? Is it a short-term need, such that someone's going to remodel a home and they want to do that within the next 24 months? Well, that's a shorter time horizon. Whereas we're going to talk about college today. So college, if someone has a child, and then there's roughly 18 years before that money is going to be used. Whereas if that's the 18 years time horizon on that, well, retirement may be 30 years out.
Right.
So it's a different timeline. So the risks someone's willing to take on, the different types of investments, when is the money going to be needed? Account types are super important. Super important. I want to camp out here for just a second. Yeah. If you're employed and you have the opportunity to take advantage of an employer-sponsored plan, let's just say 401k, 403b, 457, something of that nature, most likely there are going to be different investment options, and you choose according to your risk tolerance. But what's also important to know is that within these plans, there, especially now that it's 2026, there's going to be the likelihood of having the pre-tax and then the Roth version of said plan. This is really important. Previous episode, we talked about taxes. So if you're contributing to your traditional 401k, that's the pre-tax. That means you're deferring the income. And all that simply means is you're going to be kicking the tax can down the road. You defer income, it's growing tax deferred, and then way out there,
you're going to have to deal with it.
You're going to deal with the
bill's
taxes.
Coming due, right?
The taxes are coming due.
Well, that's what I mean. The tax
Let's
bill's
use our
coming due.
words, Miranda.
Okay, sorry.
So
I'm a student today. I'm a student.
Yeah. So it's not a bill though.
Right.
Right. I know.
I got you.
Okay. Sorry. So, but your taxes will be owed way out there. Okay. But I'm going to point out, for decades, you didn't pay taxes, yet annually you got some tax benefit.
Right.
So again, trade-off.
Right.
Okay. In the Roth, though, I'm a big fan of Roths, and here's my example. When you were younger, we talked about this. You for $1, you would dust.
Yes.
Right. Okay.
Cheap labor.
Yeah, and I would mow the yard. I would mow my neighbor's yards. I would mow anybody's yard because I was going to get money.
Right.
Okay. And that was money given to me, and there were no tax implications on that. I mean, I was getting paid
clearly
cash, right? But what I would like to point out is I enjoyed the fact that I received $10 and then I could just turn around and spend it on soda or candy, whatever it was, right?
Whatever.
Yeah. And so I just use that example because in today's environment, you can contribute to a Roth 401k. And yes, there are going to be tax implications in the year that you do it. However, there are no more tax implications for the rest of your life or the one who receives that as the beneficiary. I think that's super cool. Again, going back to how my mind thinks, if it's worth something, it's worth investing in, it's worth protecting, it's worth growing. Think about that for a second. What's best for the plan?
Right.
And every household's different. So anyway, account types. And so all of these factors come into play. Again, what the bigger picture is, what are you investing towards, which is the reason that we're here, and that there are always things that we could be investing in that don't show up with a dollar sign in front of them too.
Right. This is seriously a question of mine. I would feel like the Roth would scare a lot of people because now I've invested this money. When it comes time to do my taxes, which we just talked about, I'm already a little nervous about it. I'm already intimidated by the process. And now instead of getting possibly I overpaid, now maybe I have a bill and I didn't prepare for that bill. Like it goes back to that whole taxes and like, oof.
Well, okay. Received, heard. I would say though that for some of us, that's not intimidating. And that's the importance of being in circles that can influence healthy decisions. So I'll just use an example. In a previous episode, we talked about someone who gets a refund. Well, if you got a refund, it's because you overpaid taxes. Well, in theory, you could have contributed to a Roth 401k, of which you would owe taxes on the amount that you contributed to the Roth 401k.
Right.
Okay. And so maybe you wouldn't have got a tax refund because that amount would have paid the taxes on the Roth contribution.
I got you. That canceled it out.
It's exactly right.
Yeah.
or just you didn't overpay now, right?
Right. Yeah.
And guess what? That contribution plus the decades of growth, because again, you should expect upward and to the right growth,
Right.
even if risk adverse.
Right.
Okay.
Even with bumps in the road.
Even with bumps in the road. And so that contribution plus the years of compounding, that number will never be taxed again.
Right.
And I like the idea of, I wish more people knew that, yes, you can pay a little bit now in this Roth 401k option. You can defer, you can have a mix, and then way out there, you can have a variety of taxable or non-taxable income. Well, right now, when we're working, you don't have that choice.
Right.
My income is taxable, period.
That's happening.
I pay taxes on my income, period. The only way to avoid that, we've already talked about this. I don't look good in orange, and I'm not gonna avoid it.
Not my color either.
Okay.
Yeah.
And so, but way out there, because much like generosity, we talked about, know what you want to give. Well, how about this? Know what you want to do.
Right.
And then you can have a variety of income. And what I like about that in particular is when it comes to the tax brackets that we live in and things of that nature, the more I'm talking about that now and the more my plan is in place now, the more I get to dictate what happens to me out there rather than being told what I'm going to be doing out there.
Right.
Here's what that means, by the way, okay? So just a real quick history. When our parents were growing up when our parents were in the workplace, pensions were real popular.
Yep, my granddaddy had one.
Granddaddy, like it. Can we talk like that for a minute? Granddaddy.
Welcome to Southern Soul Jazz.
I love it. I love it. I love it. I love it. So your granddaddy had a pension, and that pension was part of his retirement plan. Well, pensions slowly faded away because they were very expensive to the organization. Mm-hmm. Okay. And so pensions were replaced with 401ks. And so this employer-sponsored plan was still intact. It was just a different type of an employer-sponsored plan.
Right.
And so now you have this 401k variety. Well, then the Roth 401k became popular, and now it's so popular it's implemented now in 2026 and 2027 because of catch-up year. Those of us that are catch-up years, 50 or older, and then there's another super catch-up at 60 or older, that now has to go towards your Roth 401k or Roth sponsored plan. That was different in 2025 and before. So things change. And so it just goes back to what's your plan?
Right.
What do you want? Because I can assure you, those who are still blessed to have their parents, go ask them if they, their two largest line items. One's going to be health insurance and the other's going to be taxes.
Yeah.
Okay? Then that's the way it is. But when they were contributing to their 401k, that's all they really had. So that was the only option.
Right.
Now ask, okay, oh, you mean I can change that? Yeah, you can change that. I can contribute to my Roth 401k. Yes, I'm going to pay a little bit of, I'm going to pay that tax obligation this year, but I will never owe taxes on that money ever again.
So when you're older and you don't have the incomes coming in and all that, you get to keep your money.
No, I just revised that. You have your income coming in, but it's not taxable.
Right.
That's a great concept. Just
you're
imagine.
You're like, yes.
I get excited about it. I nerd out on this stuff. Yeah, I get super excited about it because I wish more people understood. I'm going to use something fictitious. That way it can be, it can't be picked apart. Okay.
Yeah.
Let's say that someone paid 15% on their taxes and they're $100,000 of income.
Okay.
Okay. So 15% is owed.
Okay.
Right. And so they want to decide what they want to contribute to. Okay. The pre-tax or the Roth. And let's just keep again, easy conversation. This tax code doesn't currently exist. Let's say they want to contribute $1,000 to their pre-tax 401k. Okay?
Yep.
So they contributed $1,000 to their pre-tax 401k. Now they get to, otherwise it was going to come to their household. Right?
And go in the household business.
It's going to go in the household business. Thank you
Yep.
very much. I appreciate you putting that plug in there. Now, 15% on 1,000. So they deferred $150 in taxes.
Yep.
Okay. Now, Roth, same exact thing. I'm going to put $1,000 in this hypothetical tax environment, hypothetical, everything's hypothetical.
All pretend.
All pretend. We're really in a fictitious world right now. But I put $1,000 in the Roth, I'm going to pay $150 in taxes.
I'm not waiting to pay it down the road.
That's right.
I'm going
And
to
so
pay it
now
now.
that $1,000 compounds over decades, 3, 4, 5, 6.
And I'm not paying on
decades.
what's compounding the tax.
I'm not paying any more taxes.
That's the light bulb moment.
No more taxes.
Right. Got it.
Period.
Right.
So I paid $150 now in
Right.
this all fictitious hypothetical scenario.
Fake completely.
But I paid that because I can decipher that. I can do the math. I can figure out what I want to do.
So, okay, now hear me out. Just making sure I'm tracking with you. The account over here, the other pretend
The pre-tax.
okay, I deferred $150 in that moment with what I put in. But as it also grows, and 1,000 turns into 2,000, 3,000, I'm still putting money in, 10,000, 100,000. Now when I pay my tax bill, I'm guessing not my bill, when I have to get the can down the road and it's time to handle it. I'm assuming, if I'm doing my math in my head correct, that I'm going to pay a lot more in that moment than I would have if I had paid the $150 or whatever the amount is.
Yeah. So let's talk about that. Okay. So in this same environment.
Yep.
Okay. 1,000 went into this one.
Yep.
And I defer $150 of taxes
On that 1,000.
Yeah, on that 1,000.
Mm-hmm.
The Roth, 1,000 went into this.
I paid it.
I pay $150 in April the following year.
Yep.
Okay. Now let's just keep the math simple. Again, I'm going to totally make this fictitious so that it can't be picked apart. 'Cause you know how people love picking things
Fake.
apart.
It's all fake.
So let's just say these two, 1,000 went in, 1,000 went in. So let's just say at the beginning of one's retirement.
Okay.
Now let's just say both of these accounts are $1 million.
Got it.
Okay, $1 million.
Yep.
This one is a pre-tax account. So now one's retired, and for the rest of their life, every dollar that they take out of that account is going to go on a tax grid of which they're going to be told they owe taxes.
Right.
There's no avoid. Well, you can't.
I see what you mean.
Okay.
Orange, not a good color.
Orange, not a good color.
Nope.
You're going to live on a tax grid.
Yeah.
Okay.
So every time you make a withdrawal, or I don't know how
a
that works.
taxable-
If there's
that's right.
I don't
It's a
know if it's a scheduled payment. I don't know how that works.
Usually it is. It's usually on a monthly basis because
But every
basically-
time a chunk comes out, a chunk is going somewhere else.
That's right. Because just like when I worked at Randall's when I was 16,
Baggers.
that's right. FICA exists.
Oh yeah.
Okay, so federal income tax. Now we live in the state of Texas, so it's different than other places. Okay,
Yep.
but that's all of that $1 million is treated as a taxable event.
Right.
Okay, and so for the rest of said life, every time it comes out. Okay, now don't forget. Let's just keep the math simple. Say they retired at 65, and say they lived till 95. 30 years. It's 30 years of money coming out that they're going to be forced to pay taxes on that because they deferred the taxes in the first place. Now, let's go to the Roth.
I already paid all the taxes every year I paid when I contributed.
That's right.
So here I am rolling up to my $1 million bank account.
And you're 65.
I'm 65. I got 30 years to go. And when my monthly deposit drops, no taxes. Okay, then I'm going to ask the dumb question here that everybody wants to know. Why would you even want to have a 401k anymore?
Well, you would still have the 401k. You would just contribute to the Roth version of it.
So, okay, again, if there's a Roth 401k and a 401k, why is it just because of the tax option that some people don't want to have to pay at the
Do
end
you
of
want
every
the Matt
year?
Miller answer on that one?
I don't. That's what I'm asking.
You don't, or you do?
No, I don't know. Tell me what it is.
Because people don't know.
They do now.
It's newer. The
Right.
Roth version is newer. Okay. The 401ks existed a long time. As I said, it was a replacement of the pensions.
Yeah.
The Roth is newer. And also, can I just make fun real quick?
Go.
Okay. Some view taxes as a bill.
That's what I said.
But that's why I said, can I make fun? I didn't say, can I make fun of you? Because you would have said no. That's why I said, can I just make
I
fun?
probably would have said yes. I probably would have said yes. I'd have been like, go for it.
So some view taxes as a bill.
Right.
I don't view taxes as a bill. I look at it as an opportunity. What can I get to decide? You get to decide. And that's my encouragement. It's much like generosity. Know in your heart what makes you cheerful.
Right.
And then do it. It's the same as investing for the future. I know if I had my preference, my druthers, I would much rather have a low tax bracket income out there, which means if that's my choice, then I want to then pay my taxes here.
Right.
Now, some of your question depends on the annual household income now, because if it's a higher income, well, then there's a higher percentage in taxes being owed. And so it's something that should be discussed and massaged annually because things change.
So they're both there to accommodate the needs of the variety of people and relationships and
That's right.
couples and whatnot.
The system exists, and I use that not as a derogatory term. The system exists, and what I say is know the rules, play the game.
Right.
I mean, you can make fun of me if you wish, but don't hate the player.
You just did not.
I did. I love it. We were talking about music earlier that we grew up on. Everybody, I'm sorry for that.
Yeah, no, it's okay. I love it. That's great.
So know the rules and play by the rules, and know that if you do so, you can benefit from that immensely. And teach your children about these things. If your child works for whatever it may be, and oftentimes as when we were younger, we worked in service-driven industries, whatever it is, a type of whatever it was, restaurant or whatever. Help them understand that, and help them understand that they will just pay the taxes right now, son.
Yeah.
Just it's okay, and then
budget it in.
But that word doesn't work very well with the younger, or with anybody, quite frankly, a lot of people, but. Just help them understand that, so they'll never pay taxes again. You could just reframe it. Do you like paying the taxes now? No. Well, guess what? I'm going to show you how you never pay taxes on it again. Oh, I like that idea.
Yeah.
Oh, great. Then just do what I ask.
Yeah.
Pay this right now, and you will never pay taxes on this money ever again.
Yeah. They're like, okay.
And they're like, whatever. Can I have $20?
Yeah, just give me more money.
Get out of here.
Just give me more money.
Right.
Okay, well, investing also leads way to our other topic, which is college.
Yeah, so different time horizons.
Since we're talking about kicking kids.
Yeah, exactly. Exactly. Yeah, I like these two back to back because investing, know what we're investing for. And oftentimes retirement is one of those time horizons way out there, 30, 40 years, whatever it may be. Whereas college may be a shorter time horizon. So a child was born, and so 18 years or so. Let's remember, though, that it's not all used. Investing for college is not all used in the 18th year. There's technically a time horizon of 18 to 22, or as I like to say, I created the 5-year plan. So 4 or 5 years and even more now.
Oh, wow.
Because now masters or doctorates and things of that nature, it takes a long time.
Very important. Mm-hmm.
So yeah, you invest, and these same topics come up, the risk tolerance, because there's an 18 or more years before that money is needed. That's a long time horizon. So in theory, that money can be put into investment types that can tolerate more risk, okay? because they can grow and compound quicker than lower investments. Lower risk tolerance investments. The account type matters. For example, there are specific college type accounts known as a 529 that as money goes in and that money is contributed and then grown as long as that money is going towards, I like to think of the campus as that's the easiest way to think of it. Then that money is never taxed as long as it's going toward that purpose. So think about that. Again, kind of like the Roth 401k.
Yes.
Not taxed at retirement. This 529 contributed and compounding over 18 years. It's used for college purposes. And now that rule's actually changed because you can use it for high school and other education as well. But let's just, again, time horizon 18 years. Well, then that money compounds over all those years, upward and to the right, you should expect. That money is not taxed as long as it's going to that purpose. I mean, that's a beautiful concept. Now, just because I would say this, again, I don't want to go into specific household scenarios, but you wouldn't want to overfund the 529.
Right.
We're going to talk about insurance later. You don't want to be overinsured.
Right.
But every household's different. Every scenario is different. But there are those specifics both for retirement and college that you would want to make sure you're investing in.
So, popular question, I'm a parent. When do you have to start that? Like if that is one of your goals in your household, if you say, we want to be able to provide this for our children. Not everybody has that goal. Cool. Fine. But if that is your goal, like, is there ever a period it's too late to start? Like if you didn't really realize you could do that, is it ever too late to start? Or is there a time where it's like ideal to start? Like how do you advise people on that?
Ideal would be the longer the time, the better, because you would want that money to compound.
Right.
And that just so everybody understands what that compounding, often referred to as the eighth wonder of the world, is the money that is there is growing. So growth is growing growth.
Right.
Okay. I like to use the word and the phrase, and I have in the book a couple times, double doubles. So let's just say easy conversation, 1,000 becomes 2, 2 becomes 4, 4 becomes 8,
right.
8, 16, et cetera. So it grows over the years. And then, so the longer the time horizon, the better.
Is there a point where it's like,
I mean, it can be if your child is
graduating
16
tomorrow.
or 17. Yeah, if 16 or 17 and their college experience is going to start in less than 2 years, then I wouldn't put much of that money in the market at risk because you're gonna want that money available. Right. But then again, as I said it earlier, that it's not 18. It's not the age of 18 only or 19, whatever it may be. It's there 3, 4, 5 years they're going to be there. So it depends, but that's going to be specifically in regards to a 529. You might not want to use that, but again, every household is specifically different. But that is a shorter time horizon for sure.
What happens if I'm a parent and my hopes are that my child or children want to go to college? Like that's my hope as a parent, so I plan for that. Mm-hmm. But let's say I have one kid, because that makes it easier for this little fake story of mine. Little Johnny decides he's not really college material, or he's not interested. I mean, it seems like since I attended college, there's more of a push now in schools that college is a must. And we forget that we also need tradesmen, and we need people who, like I can't fix an air conditioning unit, and I live in Houston. I need somebody who can fix it when it's 120,000 degrees outside here. So what happens if that child develops and then their personality and in the gifts God's given them, that college is just not the thing for them?
The 529 specifically have become more flexible, and there are other account types that can be used. Right. But the 529 is more flexible now than when I started years ago in this world. And you can use it for private school prior to college now. You can use it for trade school. You can use it in a variety of ways.
But do you lose it if they don't choose any of those options? It's just
no, you can if it is not used. One, let's go to a scenario that a household has 2 children. Okay. So say the first child gets a full ride. Let's change the script a little bit.
Oh, lucky kid.
They get a full ride for whatever the reason. Okay.
Right.
They get a full ride, but there was money in a 529 for that. Well, now the next child comes up, and that money can then go to that next child
who did not get the full ride.
Correct.
Right.
And that there are no tax implications to that. It's the beneficiary of that 529 account changes, and it easy peasy. And then now there's money associated for that education. If the money, let's go hypothetical scenario that both children get full rides, and now they're like, what do we do?
Yeah.
Well, you can receive the money. There are some tax implications on the growth of that money, but you just saved yourself a ton of money.
Yeah.
So
a whole lot. It's not cheap, man.
You can get that money, and you can use it for other purposes, but there are some taxes owed on that. But again,
look what you just saved.
I
don't know how many of you have priced college lately, but I almost feel like we're outpricing college to where it's just really not an option for everybody anymore.
Well, I don't know if you intended for this, but that's a good pivot to inflation. We can use that because when I went to school, the cost of tuition was considerably less than what I paid for our daughter, and it's the same school.
Yeah.
And so that's called inflation. And we talked about this in a previous episode, but inflation is part of life.
And boy, 2025, I would say people really understood. If no one really understood inflation 2025, I think that it was in the news, it was in social media, it was everywhere.
Yeah, and it technically wasn't 2025. It was the compounding of 21, 22, 23, 24.
That exploded in 2025?
It just became more of
right. More noticeable.
More
maybe?
of a hot topic, really. Yeah. No pun intended. We're talking about it right
That's
now.
why we're talking about it.
Yeah, I mean, at the peak of inflation over the past few years, we saw that peak, and it was a little over 9%. And anything that inflates in cost of 9% is going to be realized. And then not only did it inflate 9%, but it stayed at 9%. And the next year it was then 3% on top of that, and then 2% on top of that. And so it didn't come back down, and then it goes back up. It stays there, and that we can all feel the effects of that.
Yeah, because I think what was interesting when we were planning this, you told me that a 3 to 4%,
2 to 2.5.
That's typical inflation.
That would be the ideal.
Ideal inflation. When's the last time we saw that inflation?
Well, prior to COVID, Federal Reserve would like to see unemployment at a certain percentage, and they would like to see inflation at a certain percentage. And these, from a macro and a microeconomics perspective, are what helps keep things in check. And in theory, especially in regards to investing, the markets don't like volatility. They don't like numbers that are out of the norm, high inflation, high unemployment, whatever it may be. They don't like that because that's instability. And so all of these things, they tie into each other. And
so inflation at its core affects purchasing power, right? Mm-hmm. And that also affects stress. I think you told me that back when I would have been a kid, that inflation got up to like 14.
Yeah, when we were younger, yes, yeah, and lasted for a little over 2 years. It was that. I think that's correct. I hope I'm accurate on that. It was not what we experienced. We saw a peak, I believe it was in June or July of 2022, and then it came down. So we saw it for I shouldn't say only. We experienced the up, and then we experienced the down, okay?
And then it trended.
And it trended up, so we felt that the whole way up.
Right.
And then it peaked about, I think it was 9.1 in the summer of 2022. And then it is slowly coming back down and still hovering above 3%. And that we feel that. Well, back then it was in the low double digits, or almost, 14%. That's
huge.
That's huge. And let's go back to the college aspect. So I think it's really important to understand that different things inflate at different percentages.
Right.
So healthcare costs inflated a different percentage, cost of goods, different percentage. And
oh, that's good. That's good to know. Because like I hear inflation and I just go like, inflation.
well, it's a pretty safe assumption. Everything's
Blanket.
increasing. Yeah.
Yeah.
But that's why you see college costing what it is now.
Right.
And it's crazy insane to get an education. I won't jump on my soapbox in that regard, but it's hard.
All these things that we have in our life, they do create a good space for inflation. And I also have an inflation story. So here's my deal with inflation. Thinking about 2025, we as a family felt inflation really hard for the first time that I probably ever in my whole adult experience felt inflation, right? Because everything, again, I'm a little OCD, I'm a little type A person. I think you gave it a new, remember by a few episodes back, you gave it a new name.
Enthusiast, yeah.
And I am a control enthusiast. I need to put that like on my car somehow so people will just be warned. So when you have a budget, I'm a very budget happy person. And when you have a budget, you really can feel change.
Yeah, you can see it.
You can see it like on paper with numbers. And so we felt it hard in 2025. Our house note, up. Power bill, never had paid that kind of bill in Texas for power. All the things, groceries. I think everybody felt it. Whatever you were spending your money on, because it's all earmarked to something, we felt it. And I remember, because I told you early on about money that, it's really, like God's really working with me and showing me things about money and teaching me and just all this stuff, because money was like the weird topic and conversation would come from me for money. It all ties back to that original foundation episode. And I've had to work through that a lot, and I've gotten a lot better at it. I'm still not perfect. But when I saw this shift, because, your paycheck doesn't change. It is what it is. Yep. And all the bills come out, like all the different things come out, the different sources, whatever. But that's what you got to work with. Doesn't matter if you got 12 people, 18 people, 2 people, 1 person, like that's what you got at the end of the day. It's not that, you don't get to call your employer and be like, I need a $2,000 adjustment because of inflation. Like, no. And so I learned.
Because they're feeling it too, by the way.
Absolutely.
You're right. I'm sorry for cutting you off.
No, you're right.
They're feeling it too.
They're feeling it too. I just don't think we think about that sometimes because it's coming from them, right? Like, oh, there you have it, blah, blah, blah.
We are selfish, all of us, at the root of it, yeah. Thanks
for telling everybody.
You're the PhD, not me.
Thanks. No, I'm kidding. So anyway, I said all that to say this, is that I found that my experience with inflation last year opened up a real opportunity of exposing my trust. Like, do I trust that my paycheck and my what's being provided is coming from the company that my husband works for? Or is it being provided by God who knows my needs versus my wants, knows the direction and the will for my life? And that was part of this season of studying and the podcast. And so I really saw that God opened up a door for me to have an opportunity to practice faith and stewardship a little more. Now, I will say when God opens doors, sometimes it's uncomfortable because it was uncomfortable. It was uncomfortable to wonder, oh my gosh, it's are we going to get outbilled? Or, are we going to be outbilled? And if we are, what is it? And so I remember looking and thinking, oh gosh, like in the 8 years we've been here, we've never really been outbilled. And what if this continues? And so I looked and said, okay, Lord, help me without panicking, without freaking out, without letting this consume me and me now putting my trust in my money and not my God. Like, what can I do? And like God really highlighted some areas that I probably could just scale back a little, what areas I could cut. But it was like, do you really need to do this much here? And so in the moment, I thought, I don't know that, especially, that area. But I thought, God provides, God works all things to our good. And I was like, what would it hurt for me next week to try this and just see? And I did. And I found out we didn't die. And I found out that we really didn't go without anything. And so the next week I did it again. And then I realized that I had really, in that area, which I don't mind even sharing it. It was on our groceries in that area. There was a little overage, like a little too much.
Sure.
And so I adjusted that. And for that month, that adjustment made a huge difference. And I was like, oh, thank you, Lord, for highlighting that for me. Because I would have just thought, oh, we need that at that amount, yes.
Yeah.
But just that small tweak made a huge difference. And I was so thankful for that. Because again, I want to just reiterate that with inflation, with college, with investing and all the things, God's got to be a part of those plans. I'm going to just take a step further from everything I read and say, if I was speaking directly to Christ believers and Christians, like let's just say everybody else, it's wise. That's fine because God's still working on you and all that.
We're working on all of us.
I would say that as a Christian, we are held to a different standard, and it is past wise. It is required.
Yeah.
I'm sorry.
No, I agree.
Everybody else, close your ears.
No, I agree with that. I'm just saying.
Yeah, I understand.
I just wanted to.
Yes.
I just wanted to say that.
No, I think that's fair. I think it's very fair, but I think it's extremely fair. But for Christians, I think you play by a different set of rules, and I think it's required.
Yeah.
And if you're upset, I'm so sorry. Let me just make you mad right here today in this episode.
Let's go to insurance. That'll make them even more mad.
Now, since we're making people mad,
let's
go into insurance.
Another great topic.
It's another great topic
to talk about. Yes.
I got a call in 2025 from my insurance agent who handles like our cars and house and all that stuff, right? And she never calls ever. So I was like, ooh, wonder why she's calling. And I answered like, hello. She's like, I just want to tell you about this great new product we had for insurance. I was like, okay.
Right.
That's how much I enjoy insurance calls.
Yeah. So let's talk about what it is.
Yep. Go for it.
Okay. So insurance comes in a variety of forms, but in short, it's protection against a certain event.
Right.
And there are, as mentioned, there are various types. So disability insurance, worst name ever for a particular product type. But basically, disability insurance is a replacement of income should something happen. Life insurance is probably one of the top in regards to the most popular car insurance, home insurance. We get it, but life insurance, death and taxes. We talked about that in a previous episode. It is going to happen, and so that's in the event of unforeseen event. Then that's also in some instances a replacement of multiple years of income. There's also various needs of and. That can be a planning resource. Life insurance can. Auto insurance, home insurance. By the way, I want to just real quick for home insurance, I want to remind everybody that over the past several years, our home values have increased.
Oh, you don't say.
Well, I was just throwing that out there.
Yes, they have.
And it's just important to make sure that your replacement value is what you're insuring now. And so if you haven't shopped insurance, make sure you're shopping that because it would be wise to do that. At a minimum every other year, I think it would behoove you or anybody to do that.
I shop it every year.
Yeah, there you go. See, you like it more than you think.
No, I don't like it. I just don't like how much I have to pay. So I'm always like, okay, who's out there?
Let's parlay this a little bit. Let's have a little fun with this. Okay, so in regards to inflation, so our home values have increased in value,
right?
Okay, which then increases our property taxes
and our insurance.
Which then increases our insurance.
Yep. Which,
again, that's that compounding effect that is heavy on us.
Yeah.
And we can feel that.
Right.
And I just want to take a moment to remind everybody, it's all of us experience this. And even if you're renting, it's to some degree that you're experiencing this because you may have seen or experienced an increase in rent. If you have renter's insurance, then you may have experienced an increase in that. Definitely have seen an increase in our auto insurance.
Yep.
And so we're all feeling the weight of this, hence the reason this term, inflation, is so popular now. I would just submit, we're not going to see these things just come back down.
Like ever? Wait a minute.
Pre-COVID.
Ever?
We're not going to see that. We're just not.
Never. I'm asking
Well,
you. I know you can't predict the future.
I don't have a crystal ball, and I don't want to say never ever, but that's not the way it works. In theory, what we're trying to do is, or not, the Fed chair is not calling me, just so you know.
Right, got it.
But in theory, it's to get things to a more normalized environment where inflation is 2%, unemployment is where it needs to be, and because there's always going to be a portion of our culture that is unemployed.
Yep.
Okay.
Yep.
And so that's a normal, healthy cycle is what they're trying to get us as a culture back to.
And the cycle changes because the times change and things change, right?
Well,
like pre-COVID. Okay, I think the marker now in history is life before COVID.
Sure.
And life after COVID.
There's a ton of learning in COVID, and one of the things, and I actually have it in the book, is I would like for everybody to just reflect what was life like prior to COVID. What did you learn about life while experiencing COVID, and have you already reverted back?
Yeah.
And it's just part of our human condition. And I really, really wish people would remember what they missed the most when we were forced to be without each other. And relational equity.
Right.
We missed being social. We missed being away from the people that we love, that we care about, doing things that brought us value. We missed all those things. Prior to that, because we have multiple jobs, right?
Yep.
We were running at such a pace that we kind of forgot all these things. And that was an opportunity for us to reset and to remember what we value most. And now what I would caution many who are willing to listen, are we reverting back? And there is something that we can do about it. Inflation exists. It's always going to exist.
Did you see people change? Did you see a big shift in change in how people were moving money or handling insurance or all this?
Sure.
After COVID?
Sure. Well, let's just say during. You saw a lot of this. You saw the RV industry exploded. You saw the experience industry exploded. I travel to Colorado every year, and there were more and more people moving and enjoying and living life because they could work remotely.
Right.
And so many people started to live life differently.
Right.
Okay. I saw many dual income houses go to a single income home. Because they realized, hey, you know what? Maybe we've gotten a little off course. Hey, we can make this work. We'll cut some areas here. We'll do a little bit of this. Because what we truly value most,
right,
we've kind of forgotten about.
Right.
And you know what? Okay, I can say the same about me. I've already talked about it. I've already told you the things that I did this, I did that, I bought that, and whatever. And it's part of our culture. And I really wish more people would just pause and reflect on that. And there are opportunities to do something about it.
Yeah. So we got away from insurance for a second, but that's okay because that was really important. So
yeah, insurance. So
yeah, we were.
Yeah.
Welcome to Southern
back.
Soul Chats, where you swing on the front porch and talk about lots of things and then circle back.
Insurance. So a variety of different types. I think the key to all insurance is, one, again, make sure you're not over-insured.
Yes.
Make sure that the actual product type is specific to the need. Right out of the gate, I think about in the life insurance world, there are tons of different life insurance varieties available. Know what your need is in regards to the amount, and know that there are a variety of different product types. It is beneficial to know what product type is best. I think it's super important to understand why one is recommending that. I should say it this way, I would make sure that the organization that you're speaking with know how they operate. Are they commission-based? Are they not commission-based? Know these things so that you can know what their agenda is. In our world as a fiduciary, our purpose is to provide advice. That's what we want to do. Whether you go over here and get this or you get that, we gave you our advice. And in my industry, there are two different parts of our industry, two different sides. There's a suitability world and there's a fiduciary side of the industry. And I'm not going to speak toward one or the other. We're in the fiduciary side. And I would just simply suggest that whoever is searching for a product type, know what their agenda is.
Right.
And understand how they get compensated.
Yeah, that's good. Okay, so insurance is just one of those topics. Like you said, it's weird. Most people don't know what's kind of out there. What if you had to tell somebody what the one thing to really know besides not having too much coverage, right? But what is the standout thing that you would say most people don't know this, and I need you to leave away today knowing this about insurance?
Most are needing more insurance. Mm-hmm. And as one who I don't have any licensing to get commissioned insurance, so I would still say though that in regards to life, let's just talk about life. Let's talk about life and disability. We could talk about long-term care for just a minute. But in the event that something were to happen, is the household going to be able to fill that void? Life insurance will never bring the person back.
Right.
What it is intended to do, however, is if that person is just something happens catastrophically and passes away, that income is no longer there. And it's not only for that year or that moment, it's for the rest of the years that they were going to be working.
Right.
And that's important to understand. How would your plan be able to adjust to that? That's life insurance and the importance of that. And of course, there are a variety of different types of products. And I'm not going to get into that right now, but know what product best fits.
Right.
And oftentimes, the less expensive it is, the better it is, because in theory, as you live, and you need less and less life insurance because you're saving.
Right.
Okay. Well, then, as we age, we may need less life insurance.
Right.
Okay. But there are also instances of which life insurance is an estate opportunity. It can help defer taxes because life insurance is 100% tax free. Mm-hmm. So there are benefits to having life insurance for a variety of reasons. Again, though, what's the best thing for that household? So that's that. Disability insurance. Disability insurance is what it is. Something happens to somebody and they can no longer work. Well, where's the income going to come from?
Right.
Well, it'd be wise to understand what your short-term and your long-term disability insurance looks like, because statistically speaking, it's probable that something could happen to us, and then our income is going to then, because it is not, remember what we said earlier, it's not an asset. We've talked about this.
Yep.
It's a promissory note. You work, you get paid.
Right.
You don't work,
you don't get paid.
you don't get paid.
Dadgummit.
Don't blame the employer
Right.
on this.
Right.
Okay, that's disability.
The system.
I guess you're right, but if you don't work, you don't get paid.
Yeah.
So that's disability insurance. Long-term care insurance. I think it would behoove everybody who is over the age of 50 to understand what long-term care insurance is and understand how that might or might not fit into their plan. Statistically speaking, long-term care needs, which is not health insurance, these are not synonymous. They're two different events. Statistically speaking, long-term care is growing in need.
Right.
And it's a lot. It can be very, very costly. I'm talking thousands a month, and it's a big deal. So the more the acute the care is, then in theory you could see $7,000, $10,000, $12,000 a month. Mm. And that's going to, for a lot of plans, that's going to have that's going to create a dent.
Oh, yeah.
So that's long-term care. Again, I'm not promoting it or saying it isn't needed. I'm just saying understand what best fits your plan.
Yeah.
We've already talked about the importance of home insurance, making sure that you're
Insured
up to snuff,
properly.
that you're insured properly.
Right.
That's right. Auto insurance, it is what it is. And those who have children under the ages of 25, only good news I have for you is that at 25, in 25,
only good news I got today.
at 25, if they don't have any wrecks, if they don't have speeding tickets, then in theory they can see a lower amount at that age. But
right.
But it is costly.
Yes, it is.
It is very costly.
Thank you for reminding me of all the things that are coming
And
in my future.
Yeah, there are different other insurance needs that I think do exist, and depending upon the household.
Right.
Umbrella insurance is another one that is pretty common, and for many of our clients, it's important to have umbrella insurance because they have other assets outside of their employer-sponsored plans that in the event that something were to happen, that these assets via lawsuit can be retrieved from someone else. And so you want to provide coverage. That's why.
Right.
That's a good term, umbrella insurance. I think that one.
Oof. Mercy.
Investing?
Yep.
Inflation. No, investing, college.
Yep.
Inflation, insurance.
Yep. You got them. Well, look, here's the deal. We're going to wrap it up, and I feel like we owe some encouragement and some action steps to move forward in these hot topics.
All right. Was it that weighty? I try to keep it.
No, I think it's just we all feel it. I think that
it's heavy.
We're in a season of really seeing it and feeling it and understanding a bit better than maybe a previous time before.
Sure.
And again, I think, when you live a Christian life and you put your trust and your hope in God, which can still be trying on some days, don't get me wrong, then the perspective's different versus someone who doesn't choose that path. So I'm not saying one feels weightier than the other. It's just perspective and how you look at it. It's still hard. We all have to pay debt. We all have to figure that out. We have to do what's right for each of our families. So I just think in general, they're hot topics for a reason.
Yeah.
They are. And
shouldn't be avoided. I just want to throw that out there too.
So since you're like the guru on this, what practical encouragement from just experience in your book that's out can listeners take away from this week's hot topics?
Know what best fits your need and your plan. I can't emphasize it enough. I like the last episode or previous episode. I like the scripture that we spoke of in regards to know what you want to give.
Yep.
My philosophy is if it's something is worth or something's valuable to you, then it's worth investing. It's worth protecting. It's worth growing. These things are important. My life is important to me, and so I want to protect it. I want to invest in it. I want to grow. I want to consistently do these things. Yeah, there are seasons of rest for sure. That's also a command, right?
Yep.
But what I would suggest, all of these topics are worthy of researching and doing your due diligence in and finding somebody who is an advocate of your plan. And as a reminder, if you don't have one, there are many. That's why they exist. That's what we do. We want to help people build that out and help them see it and believe in it, and then be cheerful about that.
Right.
Because that's really hard to do, is to look in the future. We can't do that. But we've also talked about that.
Yep.
We've talked about there are events that I can tell you are coming.
Yep.
I don't remember what episode it was.
For a fact. I'm going to say it's like 3 or 4. Back to 3 or 4 we did that.
Yeah. And again, starting with the end, we are all going to die. And then you can come back and then here's where you are. And so with that said, those aren't all bad. They're good. They're opportunistic. And yes, they can be difficult. Dealing with aging parents is difficult.
Yeah.
But it's an opportunity to spend time with the person you love.
Yeah.
Right? So anyway, know what they are, know how they fit in your plan, and know that you can do something about them.
Yeah, what I've learned, again, I love that I'm learning too. It's fun. Every dollar's going somewhere. Period. I don't think I really ever realized that. But every single dollar is going somewhere. And I think you have to figure out what's owed, what's given, where it's going. Like, that is solid to first off accept that. Mm-hmm. And then to whether you link up with someone or whatever path you choose is to know where your money's going. And don't just know it because you're lollygagging around with it. Be intentional. Intentional.
And remember what we talked about too, is that it, in many ways that we spend money, it's never coming back.
Ever. Never.
And it's funny. I know I won't take us off track for a long period of time. But when I was writing the book, the publicist, I had a section in there, and I wanted to speak, not graphically, but I wanted to speak to how there's a percentage of all of our incomes that literally goes toward waste. Mm. And I was talking about how we ingest and it's gone.
Right. Yeah.
Gone.
Yeah. No value to it, not coming back any shape, form, fashion.
And they said, I would kind of leave that out because what are you trying to say? What I'm trying to say is, what I'm trying to say is that there's a percentage of our income that if we're not paying attention to it, it's literally going towards waste.
Yeah. And it can add up really, really quickly.
Yes, and also detrimental is that a lot of this that we take in is not only waste, it is toxic.
Yep.
It is, and I'm not talking about things. I listen. I just said I go to the same Mexican food restaurant.
I just said I partake in Mexican food.
and you know.
And we know you love golf.
I love golf, and I wrote it in my book, so I'm going to say it here. I'm sorry if you don't like this, but I have adult libations too. It is what it is.
Yeah. Yeah.
And I just want people to know that what I really enjoy about all those things is the people I'm with.
Yeah. It's the time. You can't replace time. You can't. It's just like some of the money you're talking about is gone. Just like whatever. Time's the same way. And it's not some of your time. It's all the time. It's
right.
gone.
And we don't get to determine how much of it we have.
Nope.
So think about that and build that relational equity with the income that we have.
And invest well. If your time is limited, invest well.
And not only in yourself and others.
Yep.
Yeah. So anyway.
I love it. I think that's a good way to end.
It's your podcast.
You're the co-host, Matt.
Keep
it together, Matt.
No, I'm sorry.
I know, it's all good. It's all good. Like I said, it was a little different episode today. We had a little fun today.
Hot Pockets.
Oh, here we go. Okay. Guys, thank you so much for being with us today. I really hope you enjoyed Hot Topics. I enjoyed Hot Topics. I really did. I learned a lot today. I didn't know anything about half the stuff we were talking about, but I did learn, and I have a lot of good takeaways. And so to me, that spells success. So I hope you feel the same way. I hope today you learned something maybe you didn't know from before. Maybe you could relate to some things we talked about today. As always, share, like, subscribe. If you know somebody who these are some hot topics for them too, send it over to them. Say, hey, check this out. See what you think about what they're saying. We appreciate you being here, and we really can't wait to see you again.
That's right.
So we'll catch you on the next episode. Bye, y'all.